Hey everybody, Greg Barron here, aka the Professor of Real Estate. Thanks for joining us today. We're going to show you how you can use a small portion of your own equity and create a very large real estate empire. You're going to want to stay tuned. So if you're like me, over the years I always wondered, how were real estate deals put together where you can invest so little of your capital and control such a large project? Well, today I'm going to show you how you can actually control even a $7 million development and acquisition for as little as $267,000. We're going to pop into ProformaPlus in just a minute. So let me set the table first for how you would set this up in some terms that would help you go about to create a same real estate investment vehicle where you can continue to roll your money in and use your equity and create more and more projects. So first, let's go over some few concepts that the market is used to hearing about. You have a general partnership which controls the investment or the development, and you have limited partners which basically are members of the limited partnership, and both play a vital role. In the larger projects where you're raising a lot of capital, sometimes you might be called a sponsor, an investor. In smaller ones, you might be the general partner and the limited partner. Either way, this concept works. It's all about using a small portion of equity. You put the deal together, you plow the hard ground, you raise capital on the backside, and I'm going to show you how you can use two common elements called promoted interest and waterfall investment to control the bigger portion of the project. First, let's define the terms. You'll notice the picture that I put up on the screen here. You'll see on the top, you'll see an independent sponsor, and on the other side, you'll see an investor. Both of those contribute equity to the investment vehicle called the partnership. And if you follow the arrow down, you'll usually develop a holding company, or as they call it in the biz, holdco. And then you've also usually got a banker involved or a hard money lender that contributes debt to the holding company to ultimately give you the opportunity to have an acquisition. A real simple strategy. You set this up every time the same way, and once you get into the exercise of knowing how to create this, it becomes fairly simple. You'll always have a GP and an LP, or a sponsor and investor type of relationship. So let me introduce two more concepts and terms called promoted interest and waterfall investment. And after that, you're going to be able to understand when we pop into ProformaPlus how this actually applies. And hopefully by the end of this short video, you'll have an aha moment and say, like I said many years ago, so that's the way they do it. First, let me give you the explanation of what promoted interest is. By definition, a promoted interest is an advance given to the general partners on the limited partner's profit after the initial waterfall payments of the preferred return and capital investments are made. The remaining profits would be split according to the pro rata capital investments, but the promoted interest allows the general partner to take a negotiated percentage of the limited partner's stake as well. So hold on before you go, yeah. Let me show you this when we get into ProformaPlus, and I think this promoted interest will make a lot more sense. There's one more definition that I want to read to you, and it's called the waterfall investment. So the waterfall model or investment in real estate investing is a method for allocating cash flows and profits among partners based on levels of risk and reward. It includes components such as preferred return, hurdle rates, catch-up provisions, and look-back provisions or clawbacks, and more. So again, tap the brakes before you bail and let me explain it as we get into ProformaPlus, because this is all going to make sense and you're going to be able to utilize this in future real estate transactions. And also, go ahead and like and subscribe if you want us to keep pumping these videos out. So remember I told you I was going to show you how you could take a $267,000 equity investment on your part and control a $7 million development. Now you can use the same ratios whether you're using 50,000 of your own money and raising a proportionate share, or 100,000, the same type of techniques work. So stay with me on the numbers. Whether we add zeros or not, the same concept applies. But this particular project is a self-storage unit that I introduced early on in my videos. And really it's a development. It's going to have a construction component. It's going to have a stabilization time to lease up. I'm going to show you the ultimate investment that we're going to have, and then I'll show you how we structurally can show you how this promoted interest and this waterfall component will enable you to control the whole development, yet give you your investors the returns that they desire within the development time frame. So prior to creation of this software, most of the time I would have to use these incredibly bulky Excel spreadsheets, sometimes 15 tabs single spaced, and I would have to remember where I would data input each time. Or some of the larger investors use a very clunky and old system that frankly it takes a certification and almost a degree to run. So this is a hybrid, so you don't have to know Excel, and code is basically written for you to input at each level along the way. This is also sequentially designed so that it develops as you would develop the project. So as we jump into it, remember that this is a self-storage facility, multiple units, and I'll show you in just a second. But to kind of give you the lay of the land here, initially I've already input all the data, but I want to go specifically to how we utilize promoted interest in waterfall to make the deal work. So I'm going to run down here to the capital stack, which I previously talked to you about. And if you haven't seen my video on capital stack, you need to go back and look at those, and you'll understand this a little bit more. But this particular equity contribution is called common equity. Very simply put, it's the portion of equity that I, as an investor or developer, or you, would contribute to the deal. And it also includes the common equity that maybe 2, 3, 4, 5, and sometimes 20 investors would put up on their end. So using this software, I've tabbed down to common equity under the capital stack. And if you'll notice, like I said before, I can control a $7 million project for around $267,000. And the way that I derive that is I have set myself up to contribute 10% of the total investment that's required. The total requirement is around $2.6 million, of which a bulk of it I'm going to have to raise. And that's a part of the hard ground you plow when you develop larger projects. And if you'll notice here also, the limited partners, and again, the names are fake to protect the innocent, but I've set up 3 other limited partners, one for 30%, one for 35%, and one for 25%. And they've contributed different levels of equity along the way, one at $801,000, one at $934,000, and one at $667,000. Now, with this particular software, you can change that on the fly by simply managing your ownership. And if I wanted to add another partner or dilute the overall interest of the other partners, I would just simply add another partner here and then save that, and I would go back in here and I would rearrange their percentage of ownership. It all has to equal 100%. But the functional thing I want to show you is, again, then on this particular deal, I'm only contributing 10%. And that's not uncommon in this arena. You do all the hard work, you go out and find it, you do all the financial modeling that you need to do, and you're going to get a promoted interest, which is greater than 10% at the end of the day, while still giving your investors their return that they require. So that lays the foundation of how much equity I need overall. In this particular project, I need $2.67 million of the $7 million to contribute as equity. The rest of it's going to be bank debt, and I'll show you that in just a second. But I'm still only contributing only 10% of the overall equity. So the next thing I'm going to do is I'm going to specifically show you what promoted interest and waterfall modeling or waterfall investing does to allow this equitable cash flow split and an ultimate return of equity as a multiple to investors that you can impress. Notice as we pop into ProformaPlus that one of the columns I have on the overall project center page is common equity right here. Now you'll notice this is your $2.67 million that you've raised, and it's a part of your equity contribution as well. But look at what I'm calling the waterfall modeling, which we call hurdles and pref rate. This would be considered the promoted interest at each level here. And you'll notice that I've got 4 levels of preferred return at every level. Now, let me explain what I'm talking about. This is basically saying that I want my investors to receive 9% first, and after they receive a 9% preferred return, then we're going to have a promoted interest where they will receive 90% of the cash flow and I will receive 10% of the cash flow. The next hurdle after the promoted interest is 12%. So once my investors reach 12% internal rate of return, then they are reduced in their total return to 77% at that level, and this calculates the difference. I get 23%. The next hurdle is 15%. And then they get 63%, and I get 37%, ultimately landing on a total of 18% preferred return. And once they've achieved that, they get 45%, and I get 55%. What this does fundamentally, and I'll go back here in just a second and show you how we can change it. And by the way, these are arbitrary numbers. You can have 3 hurdles. You can have a preferred return at 9% and you split it 70-30, and then once you get to 12%, you split it 50-50 the rest of the way. You can have all kinds of scenarios, but normally your investors are going to want you to repay them a decent internal rate of return before you get a larger stake in the investment. So let me show you, based upon those calculations, just how the investor return and the general partner or the sponsor would receive their internal rate of return at the end of the day. So on this particular project, and again, I won't go into all the details of the income, cash flow, net operating income, or any of those other things that we do. But for another example, I want to scroll down to my sale at the end of 5 years and see where I would be at a going out cap rate that I've applied of 6.5%. Now, again, we're not going to go into what the NOI was, but just bear with me here for a second, and this is going to make sense. So I've established a 6.5% going out cap rate. So based upon that, my return, my total internal rate of return before tax is 25.84, a pretty decent deal overall. But I want you to look up on the top, because my investor and sponsor returns are not quite the same as what I'm showing as the overall. That's because it's somewhat distorted, because remember, I'm going to receive a promoted interest if I let them achieve their returns that they want. So at the end of the day, I would receive a internal rate of return of 37%, and they would receive a total internal rate of return of 17%. That is distorting the 25% that I showed you previously, and weighting it more to the advantage of the general partner or sponsor, because you're getting more money based upon your time, and it's an incentive for you to work harder for them to get their returns. I'm still giving them a whopping 17% over the life, but this is where it kicks in for those of us that put the deals together. In this particular scenario, I would receive 37% internal rate of return. So I realized that was a ton of information in a short amount of time, a lot of drinking from the fire hydrant, but I can assure you that if you learn those concepts, you'll be playing with the big boys in either the small projects or the big projects. Again, how you can contribute a small amount of equity on your own and control a much larger project, but you've got to have a system whereby you're able to show your investors that you're going to look after them in certain hurdles before you receive your interest first. That's the basic concept to promote and waterfall modeling. Hope that helps you today. And as always, educate, evaluate so that you can ultimately execute to increase your own personal wealth. See you soon.